Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. He says it was a relatively quiet week. Could it be the calm before the next storm? Josef Schachter, founder of the Schachter Energy Report, checks in from Calgary, where he gives us his view on what's happening and likely to happen with the energy sector. He believes big opportunities are brewing for natural gas. WolfStreet.com publisher Wolf Richter reports from San Francisco. He examines the damage done to the U.S. economy, real estate, and the automotive sector by the virus crisis. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at AMYresources.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can also find him on Twitter at ChartsByRoss. Welcome back to the show, Ross.
Good to be with you, Jim.
Compared to what's been happening on the stock market since April 23rd, a pretty calm week.
A pretty calm week. You know, we had days we were only up or down a couple hundred points on the Dow in the opening, and, you know, unlike the major activity we've been seeing, as you say, since the March bottom, that unbelievable rise there. But so we close off the week. It's the end of the quarter for a lot of the managers. You know, that will be still another 10 days away. But this is where you have the triple witching, the calendar quarter, third Friday being the end of the option cycle for both the indices, the ETFs, and the single stocks. So it's a real active day as far as the markets are concerned. Generally is actually a flat to down day, and the following week, then so that puts you into the second half of June historically. Markets typically give up 1% to 2% after you've had this realignment and everybody starts to have their new positions established. But with the run-up we've had since March, I'm sure that there's a lot of fund managers here that are banking in some pretty good numbers here. And they're with some of the stocks that have run, the Apples, the Amazons, Shopify. A lot of these managers are going to, by their the rules that they have to run by here, they're going to be lightening back on their positions. I think everybody learned their lesson years ago with stock like Nortel. Even though you felt that you really, really had to own it, it did pay to take some money off the table. So probably looking for a choppier session to continue as we move through the next few weeks in particular, because this is that mid-June through mid-August period that we've talked about before, where you get that consolidation phase, you test support in the market in election years, and with all that's going on with the election talk right now, and the bantering back and forth, and everybody seeming to come out with a new book every 10 days. There's going to be lots to cause volatility, but I think generally with that more of a flat to small downward bias.
The Canadian dollar, how's it holding up through all this?
Yeah, well, we got the reversal in the currencies a week ago, and Canadian dollar has not managed to bounce back. It's pretty much stayed down here. So, we're within a 0.25% of the first break. On the other side of the coin, the U.S. dollar has had its buoyancy remain. So we've had the better part of about 6 or 7 days off the bottom. And, I would look at the currencies clearly as having had pivotal days a week ago, that you're going to continue to see the dollar rally, U.S. dollar rally, and the Canadian and give up some ground, probably the euro giving up ground as well. We were very oversold as far as the dollar index is concerned, so at the bottom end of a 2-year trading range, so it's easy enough for the dollar index to tack on another 1 or 2%, pretty much with its eyes closed.
Oil, is it the reason the Canadian dollar didn't climb, or is there something else there?
No, when you think about it, the oil a week ago did go up and kiss that $40 level, backed off a little bit. I think 38 and change might have been the bottom end of the pullback. Closed off the week back around just shy of 40. If anything, the Canadian dollar should have done better in the latter part of the week than it did. And that will be a bit of a cause for concern if we continue to see the oil walking its way up. And we've probably got 3 days in a row here with higher highs in oil and lower highs in the Canadian dollar. That's not a good sign. And if that continues for another week or so, that'll flash for us as a continued sell signal. We did get the CRB index into a sell mode a week and a half ago. We had 9 consecutive days of upside closes prior to 4 days earlier, so that's a sequential 9 sell setup, and those historically have been good signals for the Canadian dollar. So the Canadian sold off, and now with its inability to bounce, that could be further weight to the downside. But I think we've got to give that another week or 10 days before we want to be really conclusive on that.
Ross, thank you so much for chatting with us.
Always nice to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can also find Ross at Charts by Ross. Coming up, Josef Schachter next on This Week in Money.
Always consult your investment professional before making any investment decision.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Josef Schachter, founder of the Schachter Energy Report online at schachterenergyreport.ca. He's speaking to us from the great city of Calgary, my hometown. Welcome back to the show, Josef.
My pleasure, and good to be with you, Jim.
Josef, we'll kick off the show with a listener question about natural gas. Our listener says they would appreciate if you'd have a discussion on natural gas for both the short term and throughout 2020. He says he hasn't heard anyone talk about natural gas lately, especially with prices so depressed. Josef, what is the outlook for natural gas?
Well, natural gas, because of the the slowdown in oil drilling, we've seen the natural gas side have more stability than we've seen from oil. Oil is has been bounced from, if you remember, it was negative $43, and we're now about $40. And natural gas was probably $1.80, now it's $1.67. And the U.S. drill count continues to decline. It was down another 13 rigs in the Baker Hughes report today. Canada, the rig count was down by 4. We're now at 17 rigs running in Canada versus 119 a year ago. So because the rig count is down, the amount of drilling for oil is down, and one of the byproducts is natural gas, so that's coming down, and the number of natural gas wells is coming down. And so all of that is setting up the stage for better prices in the winter of 2020, 2021. I think we're going to be looking at $2.50, $3 for ACO. We're about $1.70 or so now. And right now, NYMEX today is trading at about $1.67. And, we've been looking at NYMEX, is traded over the last number of months between, $2 and, maybe $1.60 at the bottom. And, in the wintertime, it trades at, the $2.50 level. So I'm optimistic about natural gas. I'll be on BNN on Tuesday of next week, and it's likely that I'm going to have a number of my top picks are going to end up being natural gas stories. I think oil is vulnerable to declines here. We're probably going to be seeing, OPEC cheating continuing. Demand is still pretty sluggish in the United States. We've seen, EIA data where you got inventory builds and demand is weak, both for total products and gasoline. Jet fuel is still very weak. And so I think that the optimism that people have because of the assumption of reopening. Well, if you're reopening, it doesn't mean you're traveling very far. You're not getting on a plane. You're not doing transit, in inner-city transit. You're not doing intercity transit. So I think people have been a little too optimistic, and this rally, which I think is nearly over. And I think if we do see in July when we get the Q2 earnings reports on both sides of the border, we're going to probably see some pretty horrendous results in the majority of cases. And if that's what we see, and the outlooks that they talk about for Q3 and Q4 are muted, I think we're going to see the stock market back off. So we've had a nice rally on the Dow, on June the 8th, it got up to 27,600 from that 18,000. I think we're likely to see, a number down at the 20,000 or less sometime in the next month or two, as a result of one, the pay protection program in the States is over at the end of July, so August on, people, if they don't have jobs, are going to be hurting. And that'll be put pressure on an extension of that program. But right now, Democrats and Republicans are fighting, the U.S. election, presidential election, so they're not going to want to work together. So I'm pessimistic about that. And then you take into account the earnings results from corporations, and that's also a problem. So I think that we're looking at, a bit of a pullback here. And what we're advising our subscribers is to hold some cash. If you're overinvested, take some money off the table. You've got some good gains, especially in energy. A lot of stocks from the March low when we said buy and sent out a lengthy recommendation list. Many stocks have doubled or tripled from those lows. And I think harvesting is probably something that people should consider, given if we do back off below $30 WTI in the next month or two, and the general stock market is under pressure. There's probably going to be a lot of erosion on the price of the stocks versus where we are today.
When will there be a full recovery in crude oil demand back to Q4 2019 levels worldwide?
I think you're looking at sometime in 2021 when we do have either a cure for the disease or a vaccine that we can all have available. If the vaccine is available only on limited supply to first responders, that's not going to be sufficient. We're going to need to see it available just if you want a dose, you can just go to your pharmacy and get one. And so until that is availability is total everywhere. I think that's going to limit people going, movie theaters want to open up, but you're going to have issues of, how much the occupancy is going to be. Restaurants, same issue, and so I think people going to be hesitant to fly if they don't have to, travel any distances that they don't have to. Staying in hotels is still a problem. The occupancy rates are still pretty low. So it's going to take into 2021 when we have a solution to the disease and easily accessible vaccine. And right now there's so many ways they're looking at finding solutions to it, both in everywhere around the world, that hopefully they can go through the different phases that they have to get the drug agencies, government drug agencies to approve it. But till you see all those phases done, and until you see the manufacturing systems build up to tens of millions of doses, that's going to be probably second half of 2021. That's when energy demand will get back to that 100 million barrels a day.
Did the recent OPEC extension of their production cut to the end of July solve the glut problem?
Absolutely not in my book. Number one, they didn't meet the commitment in the month of May, which came out last Wednesday. There still are a lot of countries that are cheating. And again, Saudi Arabia can cut back production because they have a small population and they have financial reserves and borrowing capacity. A country like Nigeria, Iran, Iraq, have large populations, and the majority of the revenues they get are from energy. Iran's volumes in the month of May went up. So instead of coming down, they went up. So you're looking at these countries desperate for revenue to keep their economies and feed their people. And to ask them to cut back when Saudi Arabia is so wealthy and is producing way more than they are, and they have 5, 10, 20 times the population, that to me is nonsensical. And so today the bounce over 40 that we got intraday was because there was pressure on these non-complying countries, and they were giving the typical verbal that, we'll comply in the future. Well, they're not going to comply in the future because they haven't in the past, and they can't afford it.
What happens to the U.S. and Canadian economies once the government wage support is withdrawn?
That's the $64,000 question. I'm concerned more in the States because I think in Canada we probably will see some more extension, likely, as you've seen the government announce. But July 31st is it in the States, and you have a very nasty election cycle coming. If Trump wants to extend it, he's going to have to give the Democrats what they want, i.e. support for states and cities and hospitals and first responders, not just the pay protection program and more funding for corporations as the Republicans want. So to me, it's a political football starting in early August, and that jobs report that, if you remember, the jobs report came out the first week of June, and it was a surprise on the upside. So, does the government really have the requirement to put something else out right away in August if the jobs data continues to show recovery? And the next one that comes out in early July probably will be positive as well because of the PPP. But then when you get into September, when you get the August data, that might reverse. And so, but it's also too close to the election, and the politics between the Democrats and the Republicans is nasty now. Just think about how much nastier it's going to be when we get into September.
We'll have more with Josef Schachter when This Week in Money returns.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Josef Schachter. Joseph, why do you believe WTI crude will still go below $20 a barrel in the coming months?
Well, in the month of July, I think we're going to see below 30, and then the question is, do we go below 20 in September, October? And that's if the wave 2 situation comes in where the COVID cases pick up again. Not that they're not picking up right now in the states that have reopened and people aren't watching the distance or wearing a face mask. But I think if there is an acceleration of the case count and there are closures of businesses again, because of the rise in cases and fatalities. For example, we saw Apple announce that in 4 states where there was a takeoff in the number of cases, they were closing their stores so that their employees wouldn't get would not be jeopardized health-wise. So I think we're looking at potentially maybe not state mandated or city mandated, but you may see companies make the decision that things are not safe for our employees, and unless the social distancing masks and other things are used, we're going to close up again until the second wave passes away. So the $20 assumption is based, or lower than $20 WTI assumption is based on the second wave. Below 30, I think, is inevitable simply because of the fact that there's too much inventory. And again, PPP is over at the end of July, and we're going to see weakening economic data after that. And demand is not that strong right now. Last week, for example, we had a decline in demand in the U.S., and that to me says that we're looking at weaker numbers. Like, for example, total product supplied last week was 17.3 million barrels. That's down from 20.8 a year ago, and it was down 283 on the week. You also had a decline in gasoline of 31,000 to 7.87. A year ago, demand was 9.93, so we're over 2.1 million barrels demand lower for gasoline. So we've got some pretty, sloppy conditions in the U.S., even though we do have reopening. And I think if we do see the slowdown in the economy after the PPP is over, I think that's going to be the reason why we punch through 30 in July, August, and then I think the $20 handle is a September-October window, dependent upon the COVID cases erupting again, and that causes another slowdown in the U.S. economy, and again, at a very critical time just before the U.S. election.
Where do you see energy and energy service stocks going this year?
Well, I think, we've had a fabulous rally, and in March when you and I were talking, I was saying that there was a table-pounding buy. We had, as I said earlier, we've had stocks that have gone up 2, 3, 4 times or more. Now I'm saying to people, hold off. We've had a great run. If you're overinvested, please take some profits here and build up some cash reserves. There's going to be another great buying opportunity later. I think in 2021, as I said, we will have a cure or a vaccine in the second half at the latest, maybe earlier than that. And once we see demand get back up to over 100 million, it's likely we'll be looking at a 50 minimum WTI environment, maybe even 60. And if we do get to that, we're going to see stocks much higher. So what I'm worried about is, one, the wave 2 coming during September, October, tax loss selling in November, December, because you look where stocks were a year ago, many of them are still down 60-70% from a year ago, which means tax loss selling is going to be nasty. So I think people should be using those dips, the correction that I see happening over the next month or two, the period of time during tax loss selling from mid-November through mid-December, to use as buying opportunities, and determine which names you want to own, be it oil, gas, and be energy or an energy service name, and then just be watching for the times when we see these shakeouts and be ready to nimbly buy them. I think we're going to see over the next 2 to 3 years much higher prices for oil and gas and much higher stock prices. And if that's the case, being prudent, taking advantage of the dips, is going to be helpful. So what we've done now is we've created, not only do we have our subscriber paid product, we've created something called Ion Energy that you and I chatted, and people can just go to our website under the subscription page, and it's a weekly piece we do which talks about the macro side only, which talks about what's going on with the EIA, with OPEC and supply and demand, and our conclusions. But anything stock related, you have to go into the subscriber product.
Alberta, I call the land of eternal optimism, but can it continue to be that way?
Well, I think right now with today we got another round of layoffs. Enbridge and Ovintiv are laying off, which is the old Encana for Ovintiv. And if we see really bad results in Q2 and the banks, which are doing the redetermination of the lending levels, come back and cut back lending values because the value of the resource is lower, then we're going to see, more rounds of layoffs and mergers and takeovers and take-unders. And I think we're still going to be, for the next 6 months, in a difficult environment. But we're an optimistic group. People here are used to the adversity. They know how to hunker down, and companies will survive. The majority of them will survive, and they will be stronger, going into the next cycle. And, the day-to-day demand for energy is still going to be there. We use oil in plastics. We use it in petrochemicals. We use it in our day-to-day life. We may use less in transportation because of the electric vehicle pickup in the years ahead. As more and more companies, Volkswagen, Ford, GM, start having very good product to compete against Tesla and others. But I think that we are going to see demand for energy worldwide continue to grow. because in Asia and in Africa and South America and places like that, they're not going to be able to do the transition to EV as easily, and so the long-term demand from those countries, China, India, is still a logical argument in favor of the conventional oil and gas industry. And so I think because of the underinvestment that we're seeing now, and that that probably will occur for the next year and which has happened in the last number of years for natural gas, I think that's going to set the stage for much higher oil prices. I can conceive in 2023 to 2025 that we see oil prices over 100, natural gas sustainably over $3 for AECO. And if that was the case, many stocks that I look at on my board, on my stock board here, could be 10 times the price that they are today. But, in the meantime, they could have a 2-for-1 sale. So, we're not saying, go out there right now and buy everything, but, wait for the next, decline and the tax loss selling season decline, and use those times to be appropriately buying the names you want to own for the long term.
Joseph, what's new at the Schachter Energy Report?
Well, as I mentioned earlier, we did the Ion Energy piece, and we're getting a very, very good response, and a lot of people are joining and subscribing because they want to keep up with what's going on day to day in the oil and gas sector. We just finished yesterday putting out our June SCR monthly. And so that is getting a lot of comments. I'm getting a lot of emails from our subscribers about that. And going forward, Q2 results are going to come, and they're not going to be very good. So going through those and reporting them to our subscribers are going to be key. And there's going to be survivors and companies that will get stronger, and there's going to be some that are going to go by the wayside. And so you need to be able to determine the winners from the losers, and that's where we focus our product on. And, you're not going to call it right all the time. We've had a number of companies that I expected to survive didn't, and other companies that I was pessimistic on, were able to pull their bootstraps up and find new investors. So it's a tough time right now for quite a few companies, and even the biggest of companies, like Suncor has announced that, their debt problem was concerning, so they cut back on their normal course issuer bid and cut their dividends. So even the strongest companies out there are showing signs that they have to knuckle under and be wary of lower prices and be able to sustain their business model for lower prices for, potentially into the second half of 2021.
And most importantly, Joseph, have you picked out your bow tie yet for your television appearance on Tuesday?
Yes, I did. So you'll have to turn it on. It's 10 o'clock Mountain Time, or 9 a.m. Your time in the Pacific area, and noon in Toronto. And I will be wearing a bow tie, and I even have a mask that matches the bow tie. But I probably won't wear the mask when they turn on the Skype.
Joseph, thank you so much for being on This Week in Money.
My pleasure as always, Jim. Take good care. Stay healthy.
My guest has been Josef Schachter, founder of the Schachter Energy Report, online at schachterenergyreport.ca. He was speaking to us from Calgary. Coming up, Wolf Richter, next on This Week in Money.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Wolf Richter, publisher of WolfStreet.com. He's speaking to us from San Francisco. Welcome back to the show, Wolf.
Thanks for having me, Jim.
Wolf, how much economic damage have the lockdowns done across North America?
Well, they have done an enormous amount of damage in terms of unemployment. Now in the United States, we're looking at 30 million people that have lost their jobs and still haven't found a job. People are coming back to work now, but new people are still being laid off, and so then the net number of unemployed people who haven't found a job is slightly declining, but it's still around 30 million. And, the consumer spending has taken a hit, especially on services. the GDP is probably going to be 10% below where it was in the second quarter. It's probably 20% below where it was a year ago, in that range, 9 to 10%. That's a huge hit, to get. And some of the damage is just temporary. It'll blow over. There's other damage that is more permanent, and then there's a lot of structural shifts that this has caused that were already underway, but would have taken years to play out. They now have been compressed into just a few months, and that includes the brick and mortar retail meltdown. I mean, that's been going on for 3-4 years with many department stores going out of business, with the surviving chain shutting down the stores. I mean, that's been going on for a long, long time. It includes Sears, and in Canada, Sears of Canada, of course. And now we have a period of 3 months when we see this action compressed, and what will emerge from this is going to be an entirely different retail scene. Retail has shifted to e-commerce at an astounding rate during this crisis. So this will be, and this includes e-commerce sites off of brick and mortar stores. So like Macy's and others, their e-commerce sites have boomed, whereas the stores are just in really bad shape. So this shift has sped up, and it is likely permanent that consumers will spend a lot more via e-commerce than they did before. In terms of services, a lot of things have changed too. That may be permanent. And some of the financial services are changing. In terms of going to the office, we now work from home a lot. That companies have figured out that can actually be done. So even though not all people will work from home, but more people are working from home more of the time, and that has big impact on traffic, on congestion, on commercial real estate, on all kinds of things. So this economy, when it emerges from the lockdowns fully, will be different. The old normal is gone. We can't go back to it. There will be some kind of new normal eventually, and it will be different. And some of the changes will be good. I think this working from home is going to be a good change. It will relieve a lot of the congestion problems that big cities have. It will cut costs for companies. Doing teleconferences instead of flying across the country, that's another change that's happening. That will be a good thing. It saves time and money for everybody, and it keeps pollution levels lower. It's a problem for the airlines, and they have acknowledged that. Delta Airline came out with a big screed on how tough it's going to be going forward, and they're losers on the other side of this. But some of these changes are really important and good, and a crisis will give you an opportunity to sort of look at how you can do things better, and that is happening all around the economy with consumers and companies alike looking at how to do things differently, and so that's the good part. The expense is huge that came with. So any kind of shift like this creates a lot of losers, and we're seeing that. It creates a lot of winners too, and but the expenses on the loser side, and we're seeing that all around, and it'll be permanent among the retailers. It might be fairly permanent among the commercial real estate folks and some of the funds that are involved in it. It might be a permanent problem for the mall landlords. So these are things that won't go back to where they were before. And but I think a few years down the road we'll look at an economy that has shifted dramatically, and some of it for the better. I hear that from lots of people. That we finally had what we needed to think things over and think things through and come up with a better way of doing things. So I'm only partially negative on it, and I'm partially positive because I can see the positive changes coming out of this.
I could see people who would love to work from their countryside cabin or cottage alongside the lake considering you don't have to commute anymore. You get a great view, fresher air, and your boss is just as happy with the work that you're producing. Is that a game changer for real estate?
Yeah, it is. I mean, it is definitely a game changer for commercial real estate, and that's being struggled with right now. You know, how much office do you really need in the center of a city, and do you want to be in a high-rise with 50 floors where you have to pack 20 people into an elevator, and the risk that this poses, or do you want to spread out, build campuses that are 4 or 5 stories high, and have people stay in their homes out in the country? Like you said, that will impact residential real estate. We've already seen some of that in some of the big cities where people are moving out of the city because they no longer need to be close to their employers. So they're moving into the suburbs, or they're moving further away, or they're moving into different states, and younger people moving back home, work from home. I just talked to a Google guy that way, and he left the Bay Area. He went back to St. Louis. He's working at home for Google, and is doing his work from his parents' house. And so, yeah, it has these things don't have an impact overnight on real estate because real estate is slow moving, so we won't see that. We're not seeing the numbers yet, but we're seeing the processes. So we're seeing where people are looking, we're seeing where people are interested in buying, we're seeing where they temporarily move to, and there's a lot of change underway. You're right. You think about it, you don't have to go to work every day. You can live wherever you want. Maybe once a month you have to go to the office, or once or twice a month, and you can drive a few hours to do that. That's fine. And the rest of the time you are where you want to be. And this saves the company money. It saves the employee money. You need to have a good internet connection, so it's some tech equipment, but it's not expensive, and everybody can be happier. Now, not everybody can do this, but there'll be a percentage of people that and companies that are able to do this, and it will have a big impact all around.
What's the latest on debt throughout the economy?
Oh gosh. In the United States, our national debt is piling up at a rate of about $1 trillion US dollars every 4 to 6 weeks. So we're now we just surpassed $26 trillion in national debt. Our GDP now is going to take a pretty good hit. And so as we go through this crisis, we'll probably end up by early next year with a debt-to-GDP ratio of 130%, which is astronomical. Now you're getting to where Greece and Italy were before the crisis, and so we're looking at a huge pile of national debt. Now, in terms of default, you don't have to worry about that debt because the Fed will print us out of trouble if there's an issue, and there's a lot of demand for this for these Treasury securities. So the yields are very low. So that's not an issue at this point. But it is just a huge, gigantic pile of debt that the federal government is piling up. The business is also piling up a huge amount of debt, and they have been historically high in their debt levels even before the crisis. And the Fed was fretting about that by any measure, whether it's business debt to GDP or any of the other measures. It was historically high, and now in the first quarter we got that data out, and the first quarter business debt jumped by 5% from the fourth quarter. That's the biggest jump in the history of the data. It's a huge jump. And businesses were just borrowing like crazy to get enough money to make it through the crisis, and they're continuing to do that. So in the second quarter so far, every month has been a banner month for bond issuance, including junk bonds. And investors have the hots now for everything. They're chasing yield up and down the street, and so even the worst junk bonds are being sold at relatively low yields, and there's a lot of it going on. So these corporate debt levels right now are being supported by the actions of the Federal Reserve, which is doing what it can to suppress bond yields and get investors to chase after especially junk bonds. And the Fed is buying some bonds. It's buying some bond exchange-traded funds. So yeah, this is a process that now encourages corporate borrowing. Interest rates are ultra low, and when we emerge from this crisis, the corporate debt levels will be huge. And that's a problem. Corporate debt levels, companies cannot print themselves out of trouble like the federal government can. So the way they will have to deal with it is either by, if they can't pay for it anymore, either by restructuring their debts in bankruptcy or outside of bankruptcy. And that some of this is already happening. We've had some major companies go bankrupt in the last few weeks. This is going forward. It's going to be a big issue. So we're loading up the economy with debt to get through this crisis. And, this will keep growth down in the future. You can't, when you're burdened by debt levels like this, you can't expect, companies, to grow. They're having a problem dealing with their debts. They can't invest anymore. They're overextended. And so this will be an issue going forward. And of course, the solution will be to let the weakest links go bankrupt and deal with debts in that manner. And we're set up to do that, and the bankruptcy laws are pretty effective in dealing with it. If they're allowed to go bankrupt, restructure, they will continue as enterprises. Ownership will shift generally from the current stockholders to the creditors. So there'll be a change in ownership, and generally the companies will trim down and get rid of the debts and emerge more strongly. And that's what should happen. And I hope it will be allowed to happen, because it's what needs to happen. If it doesn't happen, if the Fed continues to feed these zombies, we're not going to see any kind of corporate growth going forward. They need to shed this debt, and the only way to properly do this is by restructuring it. So going forward into the future, if this corporate debt doesn't go away, we're looking at a very, very slow growth scenario and a very dismal future years. I think the best way to do this is to clean it up now and to get it over with, and to sort of start with a fresh sheet of paper. Now, the municipal governments and the states, they are bound by their constitutions generally to not run deficits. So their debt levels have been roughly flat for the last 10 years and haven't really moved up. Consumers were in really bad shape during the financial crisis. They have deleveraged in part by defaulting on their debts and getting rid of them after it, and they have now rebuilt some of their debts. But in terms of consumer debt to GDP, it's relatively low. It's in the 70% range. So that's overall not an issue. However, there's a lot of households that are very well to do, and they have no debts at all, and they have lots of assets, and have lots of cash, and they're fine. And then there's a group of households that have a lot of this debt, and they have credit card debt, and they have other debts, auto loans and consumer loans and student loans. And these households, the lower levels of it, they are at risk, and it's there where you run into credit problems. It's lower 20 or 30% on the income scale, people living from paycheck to paycheck, and they're overextended, and that's where we had the problem last time. It's not the households that don't have it, it's the households that are over indebted, and so they're now getting offers from the government and the entities for loan forbearance and not having to pay their rent, and not having to make their car payments and all these kinds of things. But these programs eventually end, and then we'll see a fairly good wave of defaults probably going through that into the consumer debts. This is really worrisome that we're going to be emerging from this crisis with a huge, gigantic pile of debt. We emerged from the financial crisis with a big pile of debt, but it is much worse now. And part of the reason why the growth was so slow after the financial crisis is because there's so much debt. Now we have a lot more debt, and in every aspect. So, we will look at a future growth period that will probably be fairly frustrating unless we somehow can get rid of this debt.
Do you think we'll see new highs as the stock market continues to recover?
Well, we saw a new high in the NASDAQ already, and a few days ago, and we're not yet there with the S&P 500 index and with the Dow. We're still a little bit below. The Fed's balance sheet just came out today, and the Fed has actually tapered its asset purchases in recent weeks. And today's balance sheet shows that these asset purchases, that the net increase of the balance sheet was actually negative, so that the asset levels declined, and it fits the pattern where the Fed said we're going to throw everything at the crisis that we have up front, and then we're going to end this and pretty quickly, rather than doing QE forever as we did last time. And so overall, the assets have now declined for the first time since I started this. They're also shifting around how they purchase assets. So they're still purchasing assets, and they're still lending, but it's not going to Wall Street anymore. Now they've shifted to lending to states and to businesses, and rather than inflating asset prices, this is going to support spending. So this is a different path for the money that they're printing, and it has a different destiny. And so the stock market has performed this incredible feat of booming in an incredible rally amid the worst economic crisis in our lifetimes, amid corporate earnings that are going to be terrible. And some companies are going to have revenues that are down by 80% or 90%, like the airlines, and they're having huge losses. So we're facing a nightmarish corporate scenario, and the stocks have just surged and surged and surged. And the reason why they have is because the Fed threw $3 trillion in a 2-month period at it. Now the Fed has stopped throwing money at the stock market and at the bond market, and so I think that this pretty much spells the end of the stock market boom. This stock market cannot go up without constant new influx of liquidity from the Fed, and it's not going there anymore. So, of course, the Fed can change what he wants to do, without prior notice. But at this point, what it looks like, it's redirecting its efforts from propping up the stock market to propping up states and spending. And so I think the stock market has run about as far as it is going to run, and we've seen some weakness in recent days, and I think we'll see some more weakness in the next few days and weeks, and I cannot imagine that the stock market can go much higher without support from the Fed, and the support just yanked the rug out from under it.
We'll have more with Wolf Richter when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Wolf Richter. Wolf, have the lockdowns affected real estate sales and prices in the U.S.?
In terms of sales, for sure. At first, obviously, potential sellers pulled their properties off the market because they didn't want to have anybody walk through them. Many states put up limitations as to how to show properties. Buyers stayed away, so the whole market kind of froze up in April. In May, some of this started loosening up, and there's still not a lot of sellers putting their property on the market. So that has started to, but it's still not the normal levels, and there's still not as many buyers as we normally have. So the market is still fairly slow. But in some areas it's starting to pick up. We're getting more interest. We're getting more pending sales. Now, there's some shifts going on. as we mentioned earlier, there's interest in moving out of big cities into suburbs and into more rural areas. So when we talk about the national market, we don't really see that. But when we talk about specific markets, or we talk about a specific city like New York City, there are some people moving out, and they're moving into surrounding areas. And so we've seen some spikes in interest in New Jersey and some other places. We see the same thing in on the West Coast. It's way too early to really say what's happening. We have 30 million unemployed. They're out of the housing market right now. They're not going to be buying a house anytime soon. We have tens of millions of people who are worried about their jobs, who are not going to buy homes either. And they're still working, but they're worried. And so there's a limited number of potential home buyers out there, and there's interest, and it's happening. But, it's way too early, to see really where this is going, because the market just loosened up, and it just opened up a little bit, and after having been frozen. And so, we know in the rental market, that's the other aspect of the housing market, and it moves a lot more quickly. It's a market that advertises, rents, and people respond to it. And we have seen rents drop sharply in some of the more expensive areas, and including the San Francisco Bay Area. We're talking about double-digit rent declines from 1 month to the next, and we really haven't had that. So we see there's turmoil in this housing market, but it displays in different ways. And the people that are leaving, and the people are leaving the San Francisco Bay Area, they're going to cheaper places, and we have seen double-digit rent increases in some of those places. So, there are dramatic shifts happening. I think over the next 2 or 3 years we will see this play out. I suspect that expensive places like San Francisco, the Bay Area in general, will see a significant downturn in home prices and in rents, and that some other areas where people go to, that they will see an increase. We're also seeing that foreign investors are staying away. There were pretty heavy buyers in some cities, including on the West Coast. They really can't get into this market anymore right now. Also, they're probably worried about their own things. So we've seen a decline of interest on that part. So it all this will play out over the next months, not days. So we'll have to see. But my feeling is, from what I can tell, that expensive areas will take a hit in the housing market, both on the rental side and in the home price side.
What's the latest on California real estate in general?
Yeah, so that's exactly what we're struggling with here right now. The people who live in San Francisco, they want to either leave the Bay Area entirely or move out, maybe to Sonoma County, into the rural areas. There has been some of that. A lot of the people that rent and wanted to buy, maybe they're leaving the area entirely if they can work from home. And then there's some shifts within the Bay Area from expensive places like San Francisco to less outrageously expensive places such as Oakland, which are within commuting distance. But now, since you don't have to commute as often anymore, it's not an issue. Some people are moving into the Central Valley. So there's all kinds of shifts now going on, and people are talking about stuff, but they're not doing it. So we have that. They're talking about wanting to leave, and they're not leaving, and other people have already left, and so it's kind of a wild west right now. It's all over the place. And people are moving into the area too. They're coming from somewhere else, and they see opportunity, and they're moving in. And Southern California is in a different place in the market, and they have pretty heavy COVID-19 outbreaks down there in LA. That handicaps the housing market. In other areas around it, it's milder. Everybody wants to know, how is this going to turn out, and will people actually massively move? I mean, they say they will, but will they? They're talking about it. They're moving back home, but they said temporary, and they're going to come back to San Francisco. This is just all up in the air. And in prior crashes, in the dot-com crash, a lot of these people did leave, and rents plunged 25% over a 4-year period, as the city sort of emptied out. And housing prices didn't go down as much. House prices went down further after the financial crisis. We're going to stick it out here, but it's just really interesting to see how the dynamics work.
Are the riots and looting in Democrat-run cities likely to affect the price of real estate?
I like the way you framed that, Democrat-run cities. It so happens that most big cities in the United States, the people in most big cities in the United States elect Democrats for mayors. That's the case in Houston, Texas. It's the case in Dallas, Texas. It's the case in Austin and in San Antonio. It's the case on the West Coast. It's the case in Boston and New York, in Chicago, in all these bigger places. There's some exceptions, like Miami and a few others, but the majority of the big cities are, the people there elect Democrats. And they have their reasons to do that. And they do that in states that are majority Republican, like Texas. We have protests, and it's really good that we have them because we have a lot of social iniquities that need to be addressed, and it's really good to bring them up. And I'm really glad people are protesting. We had one of those protests go by our building a week ago, or maybe a couple of weeks ago, and it was over half were young white people. And it was a Black Lives Matter protest. And people have woken up. There's a lot of issues that we as an economy and as a society need to address, and that's good. In our neighborhood, we also had every drugstore looted by a convoy of cars from Sunday night, and they drove from store to store. They had nothing to do with the protest. There were no protests anywhere near. And they just broke into every one of the drugstores, all the Walgreens and CVS's, and looted them. And, so we have these two different things that are going on, and it is not an enticing thing for home buyers, potential home buyers, to have to deal with this. I don't know if it has an impact because it's sort of settled down, at least here in San Francisco. There's still some protests, but the looting has stopped essentially, and it impacts mostly some specific areas. In other cities, it's different. I think the protests will lead to a long-term change that I think will be good for the economy and will be good for the people. And I think that's positive, and that's good, and it takes a while to get there, and it may be costly to get there, but that's good. The looting is not good, and it's always terrible when I see that. There's looting going on in hurricanes, so when there's a hurricane in Texas, in some place you have looting. And that's not in other countries. In Japan, you have an earthquake and there's no looting. And you have a typhoon and lots of people die and lots of things happen and there's no looting. The looting is something that we in America are doing, and it always surprises me when it happens, but it does happen. It's a feature, and anytime there's a crisis, we've got this. And so I don't know that it has a long-term impact on the housing market. I think a healthy economy is important for the housing market, and if you get a healthy economy, we'll have a healthy housing market. I think the current turmoil in the streets is is not something that will long-term impact the overall housing market. Now, it might be that some specific neighborhoods that got hit pretty hard will have trouble recovering, and I can see that. But in terms of the city overall, I don't think it has a huge impact.
How's the U.S. automobile market holding up?
Yeah, so sales collapsed in April, and then there's some recovery in May, and new vehicle sales and used vehicle sales were down close to 20% in May from a year ago. The problem we have in the new vehicle market is that there's a supply shock, and the manufacturing plants have been shut down, so we don't have a lot of supply. And there's also demand shock in that there's not a lot of demand for new vehicles. It's the first time in my life, I think, that I have seen a supply shock and the demand shock hit the market at the same time. And it does some peculiar things, because if you don't have enough vehicles to sell, you're not going to make good deals. You're not going to offer good deals. And even if there's not a lot of demand, and that's what we have now. There's not a lot of demand. Demand is down, but supply is down. So dealers are not sitting on huge piles of inventory, and they know they can't get any more for a while, and so they're really on new vehicles. There are really not any good deals available, and same thing on used vehicles right now. The auction volume has recovered. It froze for a while in April, and it has now recovered. So there's more cars going through the used vehicle auctions, and so there's a little bit more supply coming on. But the rental car companies, two of them went bankrupt, including Hertz, the big one, and they're trying to get rid of the inventory, but they hadn't started the process yet. So those vehicles are not going through the auctions yet. They will start maybe later in the summer. So we don't have a huge amount of supply going through the auctions to go to the dealer lots. And so they're not making great deals either. They did at first in April and May. There's some price cutting going on, but that's pretty much worked itself out of the system. So this market is still not back together like it should be. So there's not enough. The supply chain for this market hasn't opened up at all. I mean, they're still not putting out the vehicles that they're supposed to on the new vehicle side. The demand is low, and this combination of supply and demand shock, I think, could produce some strange results in that. I've been predicting that when the rental car companies selling the bankrupt ones are selling their vehicles, it will put downward pressure on the used vehicle prices. But the next year, those vehicles will be gone, and there'll be a shortage of used vehicles. So there are probably going to be higher prices on used vehicles next year. And new vehicles, we're already building a shortage into the system because the manufacturing plants are shut down. After the financial crisis, it was all about making deals, about cutting prices. I'm not seeing that. This market is very different, and it's not healthy, but it's we're not seeing surplus inventory, we're not seeing price cutting, and we're not seeing a lot of demand. It's a very peculiar market.
How's the luxury vehicle market doing? Is it different?
Now, luxury, if you talk about price here, so $50,000 and up, maybe, that covers a lot of trucks. And trucks have done fairly well during the crisis, while car sales have kind of stopped. Trucks, particularly pickup trucks, they have sold, and across the board. And so that, and this is people who have the money, who can afford to buy these trucks. They have the reason for buying pickups, maybe given that the uncertainty and the crisis has stimulated them to buy a bigger vehicle. A lot of these trucks are very expensive. Some of them go close to $100,000, and that end has held up. So It's one of the things we're seeing here. Now, the unemployed are not going to buy a vehicle, and the people worried about their jobs are probably not going to buy a vehicle, but people who are not worried, they could buy, and many of them bought trucks and expensive trucks. So that's the luxury end that's held up pretty well. And, to everyone's amazement, even though we shouldn't be amazed, the wealthy people didn't really take a hit in this crisis. It was the people who worked in restaurants and retailers and did service jobs like in nail salons and hair salons who got hit the hardest.
Is there demand for transportation fuels in the U.S.?
Yeah, so if you want to see how the economy is working, we can look at it different ways. One way is to look at the transportation sector, what it's burning. And so gasoline consumption, for example, is still down and has been down about 20% for the past 5 weeks. It was down 45% in April and throughout April, really. And now it's picked up, but it's still down over 20%. And that's significant. It shows us that people are driving less, especially commutes. So that's they're working at home. It's being unemployed. It's those kind of things that cause people to not commute, and we see that. In gasoline consumption, 20% decline. I mean, we've never had this kind of decline before. It was 40%. I mean, that's historic declines. We're looking, normally when gasoline consumption declines by 5-10%, that's a big thing. So now year over year, we're down 20%, have been down 20% now for the last few weeks. These are historic changes in gasoline consumption, and we're still, way below where we were in recent years. You have to go back to something like 2000, to get to the gasoline consumption of where we are right now. This is how commuting has changed. Now, in terms of jet fuel consumption, obviously, airplanes are not flying anymore to that extent. A lot of flights have been canceled. The TSA has shown that passenger traffic through airports is down by around 80% from a year ago. And so jet fuel consumption has plunged too, and it's down. At the peak, it was down 80%. Now it's down about 50% from a year ago. Now, a lot of cargo flights are still going on, so that end, and freight rates have gone up. That end is strong, but passenger flights are scarce, and that continues to be the case. The last week we had, it was jet fuel consumption was down over 50%. The recovery there will be very slow, and we've seen that after each crisis that we had, the 9/11 crisis in 2001, and then financial crisis, it will take years for airlines to get back to the revenue figures, and that will show up in jet fuel consumption. And right now we're just still over half of where we were a year ago. This down 50% is a gigantic drop in jet fuel consumption. In terms of diesel and heating oil, we lump them together into one category, so we can't really separate them out. Heating oil is used in some parts of the U.S. for heating purposes in the winter, and diesel can be used for power generation also. So it's not just transportation fuel, but that also has dropped, but not as much. So right now in diesel fuel consumption, we're down about 10% from a year ago. We were down about 20%. The trucking industry and railroads, of course, have gone through a tremendous downturn, and that started 18 months ago, and long before the pandemic. And it just took on a different magnitude during the pandemic. So we see that in the consumption levels here. It's not as strong as with gasoline, but it's still pretty significant. Now we got to keep in mind that e-commerce has boomed, and so there's a whole delivery infrastructure in place for e-commerce, and that infrastructure has been inadequate to deal with the boom in the business. And so there's a lot of fuel being burned in that delivery vehicles. Yeah, so it's the last mile, and it's the trucks that run across the country. And any transportation business exposed to e-commerce has done really well. If you're exposed to the industrial sector as a transportation business, you're for the oil and gas drilling and those things, it's been really, really tough. Now, overall, our fuel consumption for transportation is still down about 22% from a year ago. And it's been that way for a few weeks. It was down more like 40%, so it's come up from that. But these are historic drops. And when you look at a chart, a long-term chart, there's no data in the data series that shows where we were in May, and we've dropped so far. We dropped out of the data series. Now we've come up, but it's still where we were in the 1990s. So, this transportation sector all around. So people driving to work and planes, aircraft flying, and cargo and passenger, and then the whole trucking railroad sector. They have taken a very big step back, and obviously we can see that. We can see it in the sky. The air is clearer and cleaner, and the container ships. I live in San Francisco with view of the channel where the container ships go through to the port of Oakland, and there used to be just one after the other. Now there's a lot fewer container ships going through, and they burn bunker fuel, which is the worst kind of fuel out there, and it's really sooty. It's terrible, and so the air in San Francisco has cleared up a lot, and so that's you can see that. So there, that's the corollary to the plunge in demand for these fuels, and You can tell that whatever discussion there is about the V-shaped recovery, the transportation sector tells you that this will be a long slog, and it's not going to be a quick thing.
Wolf, before we go, can you tell our listeners a little bit about Wolf Street?
Yes, wolfstreet.com focuses only on finance, economics, and business issues. We don't do politics. We try to analyze the world out there as we see it, the stories behind business, finance, and money, as you call it. And we have a very polite and interesting comment section with all kinds of people contributing. So we're very pleased to have all these commenters out there.
Wolf, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Wolf Richter, publisher of WolfStreet.com. He was speaking to us from San Francisco. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Josef Schachter, and Wolf Richter, and thank you for listening. If you have any questions for our guests or for the show, you can send them to info@HowStreet.com. Now stand by for a company showcase update from American Manganese President and CEO Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of How Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Jim, happy to be on the show.
Larry, Tesla plans to get their battery plant up and going. What kind of news is that for people who are in the battery recycling business like you?
Well, the thing that we're looking forward to is the battery days, which has been postponed, and there's no real date out there, but it's getting a lot of press. And so it should, because Elon Musk, as far as I'm concerned, is the major reason that we have a
EV cars out there and new battery technology. I mean, he was first out of the gate and did a great job of promoting the Tesla cars, EV cars, and and a great job of promoting battery technology. And now they're going to have a battery day. I'm not sure when. It could be next month. It might be in the fall. But what we're hoping to see in the battery day is we're hoping to see some talk about recycling. It would appear that most of the talk today is about the EV car itself, the battery technology, the reduction of costs and everything else, and very little, if anything, about recycling. And so we're hoping that he's going to start talking about recycling, at least, put a paragraph in. So we're anticipating, waiting with anticipation to listen to his battery day presentation. And I imagine that, millions of people are waiting for that. That's the kind of audience he has. So, we're just another group in the lineup, but we have some great technology that, as far as I'm concerned, every battery manufacturer or EV car manufacturer should be interested in it because it also reduces the cost of a new battery. And, and it's not getting burnt to a cinder. It's not, polluting the air. It's not going into dumps. It's a closed circuit solution that we have, and we've had interest, of course, from tier one companies, and we continue to have that interest. And but it's not reflected down from the companies themselves in the public arena. What they're actually doing about it, except to say that they recycle batteries, and unfortunately, they take a black mass and it probably ends up in a smelter somewhere. So we're anticipating what Elon's got to say, and we think that's going to be a fantastic situation for recycling if he does mention it. And, because Tesla, I think, started working on a recycling program back in 2010. And so it's not like it's a stranger to them. And we just anticipate that the battery day will have a good influence in all aspects of the business, including recycling. Now, talking about recycling and everything like that, we recently put out a OPED with the Economic Standard on the criticality of manganese. And I'd just like to say that as of this morning, it had 37,500 reviews, which takes us up close to 200,000 reviews on the four, including this one, the 4 OPEDs that we've done. So that's creating a new audience for us, and we're very happy with the results. We've broke some records at the Economic Standard, and I'd like to continue doing so. So this is not the end. There's more reviews coming. But, getting in front of a new audience never hurts when you're in the mode of, where we want to build a commercial plant and we want to attract attention. And so that's one great attention getter. On the exchange, our stock has had a couple of Hail Mary, well, I shouldn't say Hail Mary, it had a couple of tremendous days in the market. We hit 20 cents on the first day of a bunch of buying. We have a long-standing shareholder that took another big position in the company, and certainly he took the market by surprise, and it went up as high as 20.5, closed down at 17 yesterday, 18.5, and now we're pounded a bit today, which was not to be unexpected. We're trading at 16.5, but we still got great volumes in the U.S. and Canada, which is telling me that it's not going to take much to get this thing off center and get back in the race. Even with COVID out there, it seems like we're getting a lot of attention. And just to have a little word about the pilot plant. The pilot plant is ongoing, except that we're had to get some specialty parts in, and we're still waiting for those to fire back up. But it's not a showstopper. I talked a lot about the pilot plant the last podcast, in which I pointed out to people that we might be able to double the size and significantly reduce the cost of a new commercial plant. So that's ongoing, and we've got lots of exciting stuff in the pipeline. It's not that we've been sitting on our haunches. It's the COVID virus created a lot of interest for us from people that had time to think about things and pick up the phone or send an email, and so we've been in discussions with them. But it looks like we've had a couple of real beautiful days here in the Lower Mainland, and I'm hoping to see it continue into the weekend. And I wish everybody a very good weekend coming up with good weather, and I'm certainly looking forward to it. And that's the end of my podcast today, Jim.
Larry, where are you traded, and where can people get more information about American Manganese?
We're traded on the TSX Venture Exchange under the symbol AMY. We're traded in the U.S. under the symbol AMYZF. We're traded in Frankfurt under the symbol 2AM. Our website is AmericanManganeseInc.com. You can reach us at 778-574-4444, or you can email me at LREAUGH@AMYMN.com, and we can get all the information that we can out to you.
Larry, thank you so much for the update.
You're welcome.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on June 19th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.